If you're a senior, an immigrant, a green card holder, or anyone navigating US taxes, you need to hear this. Starting in 2026, everything about how you file taxes is about to change dramatically. And I'm not exaggerating. This could affect your savings, your tax refund, and honestly, your entire immigration journey if you're not prepared. Here's the reality. You've been filing taxes the same way for years, maybe decades. It's routine, it's familiar, everything works. Then suddenly, the IRS sends you a notice saying you failed to report something you didn't even know existed. Now imagine that one mistake triggering penalties, audits, or worse, delays in your citizenship application. That's exactly why this matters so much. In 2026, the IRS is rolling out new mandatory reporting requirements that specifically target anyone over 60 and anyone not born as a US citizen. And the scary part? Most people have absolutely no idea this is coming. That ignorance could cost you thousands. But here's what I want you to understand right now. I'm not here to scare you. I'm here to prepare you. Once you understand what's changing and take a few simple steps, you can completely avoid these problems. So let's break this down clearly. Starting with the 2026 tax year, that's the returns you file in early 2027, the IRS is expanding what they call mandatory reporting requirements. Basically, the government wants far more detailed information from specific taxpayers about money, assets, and income outside US borders. Here's what this means for you. If you're 60 or older, or if you weren't born a US citizen, you'll now answer additional questions directly on your standard 1040 form. These questions cover foreign bank accounts, foreign pensions, foreign social security, and international money transfers. Used to be, these questions only appeared on specialized forms or were sometimes optional. Not anymore. Starting 2026, they're mandatory for millions of people. The IRS is also strengthening data sharing between agencies. Your tax information will be cross-referenced with immigration records and financial data more thoroughly than ever before. The government's goal? Reduce what they call unintentional noncompliance, basically catching people who broke rules without realizing it. But here's the hard truth. Once this rule takes effect, the responsibility is entirely yours. You have to answer these questions correctly and completely. Even if you've filed the exact same way for decades, your 2026 return will look completely different. Ignoring these changes could create serious, lasting problems. Now, let's talk about something that really matters. The reporting thresholds for foreign financial assets are changing dramatically. In the past, you only had to file Form 8938 if your foreign assets exceeded $50,000 at year-end or $75,000 at any point during the year if you were a single filer in the US. But the new 2026 rule slashes those numbers. If you're over 60 or you're an immigrant filer, the threshold drops to just $25,000 at year-end or $40,000 at any point during the year. That's a massive change. Suddenly, people who never had to report foreign accounts are now required to do so. And when we talk about foreign assets, we're not just talking about investment portfolios. This includes a simple bank account in your home country, a small retirement account from years ago, a life insurance policy with cash value, even partial ownership of family property overseas. There's also the FBAR, the Foreign Bank Account Report. The FBAR rules themselves aren't changing. You still need to file if your total foreign accounts exceed $10,000 at any point in the year. But here's what is changing. The IRS will now automatically cross-check your answers on Form 1040 against your Form 8938 and any FBAR records. If you say yes to foreign accounts but fail to file required forms, or if the numbers don't match, the system generates automatic notices. It could trigger an audit. Bottom line, there's significantly less room for mistakes, misunderstandings, or forgetting to report something small. So why are seniors and immigrants being targeted with this new rule? The IRS has a clear explanation. These two groups represent the largest source of unintentional mistakes with foreign account reporting. Many seniors have lived complex financial lives. Some retired abroad and moved back to America. Others receive small pensions or government benefits from countries where they worked decades ago. A lot of seniors simply don't realize that the United States requires worldwide income reporting, even if that income is tiny or already taxed elsewhere. The same applies to immigrants. Millions of people who move to America keep bank accounts, property, or investments back home. They use these accounts to support family, handle emergencies, or manage finances in their country of origin. From their perspective, these accounts have nothing to do with U.S. taxes, but under U.S. law, they absolutely do. The IRS doesn't think most people are intentionally hiding anything. They just don't understand the complicated reporting rules. The problem is, whether a mistake is intentional or not, it's still non-compliance in the government's eyes. So instead of hoping people discover these obscure forms on their own, the IRS is forcing the issue. By putting questions directly on the main tax return and lowering thresholds, they're essentially saying no senior or immigrant can claim ignorance anymore. Even a small inactive bank account you forgot about could require formal disclosure. Now let's talk about how this affects different people differently. If you're a senior and a U.S. citizen by birth, you might think this doesn't concern you. Think again. Under the new requirements, any senior over 60 with financial connections outside America will answer expanded questions on their tax return. If you receive a pension from another country, if you have savings overseas, if you own property or investments abroad, you now must disclose that information clearly and completely, even accounts that are rarely used or that you only keep for convenience when visiting family count. The IRS is no longer treating foreign assets as something only wealthy people worry about. For seniors, the expectation is that if any foreign accounts exist, they must be reported properly and in detail. For green card holders, things get more delicate. You're already required to follow the same tax rules as U.S. citizens, including reporting worldwide income. But here's what makes this new rule especially critical. When you apply for U.S. citizenship, USCIS reviews your tax history as part of the good moral character requirement. Under the updated system, USCIS will have greater access to IRS data. They'll see whether you answered foreign account questions correctly, whether you filed required forms like the FBAR or Form 8938, and whether inconsistencies exist in your records. This doesn't mean one simple mistake automatically destroys your citizenship application, but any mismatch or missing information can trigger delays, additional questioning, and heightened scrutiny during your naturalization interview. In serious cases, real tax non-compliance could even lead to application denial. That's why green card holders need to be extremely careful and organized once this rule takes effect. If you're a naturalized citizen, you might think these rules don't apply to you in any special way now that you're American. But the IRS has specifically included naturalized citizens in the expanded reporting group. The reasoning is straightforward. People not born in the United States are statistically more likely to maintain financial ties to other countries, even many years after becoming citizens. So even though you're treated like any other American for tax purposes, you'll still answer the new questions in greater detail. For those on work visas or other temporary statuses, this matters significantly too. If you meet residency requirements for U.S. tax purposes and file returns here, you're subject to these expanded obligations. For visa holders hoping to apply for a green card eventually, tax compliance is extremely important. IRS reporting problems can complicate visa renewals, status adjustment applications, and other immigration benefits. In short, this new rule touches almost anyone who's lived, worked, or built a life across more than one country. So what should you actually do to protect yourself? Instead of worrying endlessly, take a few practical steps right away. First and most important, gather complete information about any financial connections you have outside the United States. Create a clear list of every foreign bank account, pension, investment account, insurance policy with cash value, property interest, or business ownership you might have. Even if an account has very little money, even if it's been inactive for years, even if you only use it occasionally when traveling, it still counts. Write down the institution name, the country, the account number if you have it, and the highest balance during the year. Many people get into serious trouble simply because they never organize this information. Doing this one step early saves enormous stress later. Second, review your current FBAR filing situation. Remember, the FBAR requirement already exists today. It's not waiting until 2026. If your total foreign accounts ever exceeded $10,000 at any point in the year, you're required to file electronically with the Financial Crimes Enforcement Network. This applies even if each account is small. Many seniors and immigrants are genuinely surprised to learn this rule has existed for years. If you realize you were supposed to file FBARs in the past but never did, don't panic. The The IRS offers streamlined filing procedures that let people come into compliance with reduced penalties if the failure wasn't intentional. The worst thing you can do is ignore the issue and hope it disappears. Taking action now before the new 2026 system increases enforcement is genuinely one of the smartest decisions you can make. Third, prepare for the new Form 8938 requirements. Because thresholds are being lowered dramatically, many people who never filed this form will suddenly need to start. If you believe your foreign assets might exceed the new limits of $25,000 at year-end or $40,000 at any point during the year, begin collecting statements and records now. Form 8938 requires detailed information about each asset, including values in US dollars. Waiting until last minute during tax season makes this incredibly difficult, especially if you need to contact foreign banks for old records. Being proactive makes the transition to new rules much smoother. Fourth, make absolutely sure you're correctly reporting any foreign income you receive. This matters especially for seniors getting pensions or Social Security type payments from another country. Many people assume that because this money is already taxed overseas, it doesn't need reporting in the United States. Wrong. In most cases, U.S. tax law requires reporting worldwide income, including foreign pensions, annuities, rental income, or interest earned abroad. Some countries have tax treaties with America that may reduce or eliminate double taxation, but those rules vary country to country and can be complicated. The new IRS questions on Form 1040 will specifically ask about these payments. Ignoring them is no longer an option. If you're unsure how to handle foreign income, speaking with a qualified tax professional who understands international tax issues makes a tremendous difference. Fifth, particularly important for green card holders and anyone planning to apply for citizenship, keep organized records of everything related to your taxes. Save copies of your tax returns, FBAR filings, Form 8938 if you file it, and any documents showing the value of your foreign accounts. When you go through naturalization, USCIS may ask to see proof that you've properly complied with tax laws. Having clear, well-organized paperwork turns what might feel like stressful interrogation into a simple, straightforward conversation. Many immigration delays happen not because someone did something wrong, but because they can't easily prove they did things right. Good record keeping is one of the easiest ways to protect yourself. Let me share a real-world example that shows how easily problems develop. Imagine a senior immigrant who's lived in America for decades and always filed taxes honestly. She keeps a small bank account in her home country with about $15,000, money she uses when visiting family. The amount seems small, and she never thought of it as connected to American taxes. She never filed an FBAR and never mentioned it on her tax return. Years later, when she applies for U.S. citizenship, the immigration officer asks about foreign accounts. Suddenly, this small, innocent account becomes a major issue. Her application gets delayed while she works with a tax professional to correct past filings and prove the mistake was unintentional. The entire process becomes stressful, expensive, and frightening. Under the new 2026 rule, situations like this are far less likely to be overlooked. The mandatory questions on the tax return force her to think about that account from the beginning. In many ways, the new system is stricter, but it's also clearer. It removes confusion and makes it much harder for honest people to accidentally make costly mistakes. Now let me address some common questions I know you're asking. First big concern: does this affect regular U.S. Social Security benefits? The answer is no. Nothing in the 2026 IRS rule changes how normal U.S. Social Security payments are taxed. Those rules stay exactly the same. What the new rule focuses on is foreign Social Security or pension payments from another country. If you receive retirement benefits from a government outside the United States, those payments are generally considered taxable income here unless a tax treaty says otherwise. The expanded questions on Form 1040 will now ask more clearly about these foreign payments. You'll need to report them accurately instead of assuming they don't matter. Another question: do tax treaties still apply? Yes. Treaties between America and other countries can still reduce or eliminate double taxation, but you must properly report the income first to claim those benefits. The new rule doesn't cancel treaties. It just makes it harder to ignore foreign income altogether. Now let's talk about penalties. This is crucial. The IRS takes foreign account reporting incredibly seriously, and consequences for mistakes can be severe. If you fail to file an FBAR when required, the penalty for a non-willful violation can be up to $10,000 per account for each year you didn't file. If the IRS believes the failure was willful, penalties can be far higher, sometimes reaching 50% of the account balance. For Form 8938, the penalty for not filing when required starts at $10,000 and can increase to as much as $50,000 if the problem continues after the IRS notifies you. Beyond financial penalties, there are practical consequences. Failing to report foreign assets extends how long the IRS can audit your returns. For immigrants, it creates serious complications with visa renewals, green card applications, or citizenship cases. The important thing to remember is most people who get in trouble didn't intend to break any rules. They simply didn't know what was required. The new 2026 system is designed to remove that excuse by making requirements impossible to overlook. As we get closer to 2026, keep the bigger picture in mind. This new IRS rule isn't designed to punish honest people. The goal is creating a tax system where information is clearer, reporting is consistent, and everyone follows the same rules. For many years, foreign account reporting has been confusing and easy to misunderstand. Millions of seniors and immigrants made small, unintentional mistakes simply because requirements were buried in complicated forms most people never saw. The new system brings those questions directly onto the main tax return, so people cannot miss them. In a way, this actually provides more protection for ordinary taxpayers. If you answer questions honestly and keep proper records, you should have nothing to fear. If you realize you may have made mistakes in the past, options still exist to correct them before the new enforcement system becomes stricter. Acting early, getting organized, and seeking professional advice when needed are your best protection strategies. The most important message I want you to take away is this: knowledge is your greatest protection. This rule change may sound intimidating at first, but once you understand it, the steps to comply are very manageable. Gather your information, understand your filing obligations, keep good records, and don't ignore foreign accounts simply because they seem small or unimportant. Small details are exactly what the IRS will be paying more attention to in the future. If you prepare now instead of waiting until last minute in 2027, you can avoid nearly all potential problems this new rule could create. Let's recap everything quickly so it's absolutely clear. Beginning with the 2026 tax year, the IRS is introducing expanded mandatory questions on regular tax returns that specifically affect seniors over 60 and anyone not born a U.S. citizen. These questions focus on foreign bank accounts, foreign pensions, foreign social security, and other financial connections outside America. Reporting thresholds for Form 8938 are being lowered, meaning many more people will now report foreign assets than ever before. The IRS will cross-check information more aggressively between tax returns, FBAR filings, and immigration records, leaving much less room for mistakes or misunderstandings. For green card holders and people applying for citizenship, accurate tax reporting becomes even more important because discrepancies can lead to delays or extra scrutiny. None of this means honest taxpayers should panic. It simply means paying attention to foreign financial reporting will no longer be optional. By gathering records early, understanding your obligations, and seeking help when needed, you can navigate this change smoothly and confidently. The people who prepare ahead of time are the ones with nothing to worry about. If this video helped you and you want to stay updated on future changes affecting seniors and immigrants, subscribe to Dream Visa Updates so you never miss important information like this. Tax laws and immigration rules change quickly. Staying informed is one of the best ways to protect yourself and your family. I need to remind you that everything in this video is for general informational purposes only. It's not legal or tax advice. Every person's situation is different, and rules can be complex depending on your country of origin, income, and financial history. If you have questions about your specific case, speak with a qualified tax professional or immigration attorney who can review your individual circumstances. Government policies change, and official guidance from the IRS and USCIS should always be checked when making important decisions. Thank you for spending this time with me and for taking steps to protect your financial and immigration future. I'm George from Dream Visa Updates, and I'm here to help you stay informed and prepared. Stay safe, stay organized, and I'll see you in the next one.